On November 22, 2021, U.S. stock market Nasdaq index touched all-time high of 16,212. Investors were euphoric at seeing their wealth multiplying. A lot of middle-income families were expecting to grow rich in the days to come. There was so much optimism in the atmosphere. A lot of new buyers were entering the market at the prospect of growing rich. But they had no idea what the coming winter has in store for them. By the end of January 2022, the Nasdaq index dropped by 11.5% in value. But this was not enough. The market kept dropping to such an extent that on June 16, 2022, the Nasdaq made a low of 10565, an astounding drop of 35% from November highs. Most of the companies have lost more than 50% in their market value. Some have lost even 90%. But what does a stock market crash mean? What causes a stock market crash? Can we do something to avoid getting stuck in a crash? Stay with us and we will explore. A stock market crash is a sudden, sharp decline in the value of stocks. It can happen for a variety of reasons, including economic recession, corporate scandal, or panic among investors. The effect of a stock market crash can be devastating to the economy, and it can take years for the markets to recover. A stock market crash is a rapid and often unanticipated drop in stock prices. It can be a side effect of a major catastrophic event, economic crisis, or the collapse of a long-term speculative bubble. The worst stock market crash in history started in 1929 and was one of the catalysts of the Great Depression. The crash abruptly ended a period known as the Roaring Twenties, during which the economy expanded significantly and the stock market boomed. The Great Depression lasted approximately 10 years and affected both industrialized and non-industrialized countries in many parts of the world. A stock market crash typically happens when there is a sudden sell-off of stocks, and this can happen for a variety of reasons. One reason may be that investors are worried about an upcoming economic recession. Another reason may be that there is a corporate scandal that has caused investors to lose confidence in the company. Finally, panic among investors can also cause a stock market crash. The effect of a stock market crash can be devastating to the economy. When the stock market crashes, it can lead to a decrease in consumer spending, which can then lead to layoffs and an increase in unemployment. A stock market crash can also cause businesses to fail and banks to close. In addition, the value of homes may decline and people may have difficulty qualifying for loans. It can take years for the economy to recover from a stock market crash. The after effects of a crash can be severe. In the short term, there can be a loss of confidence and a decrease in the value of stocks and other financial assets. In the long term, there can be a decrease in economic growth and an increase in unemployment. There are several potential reasons for the current crash in the U.S., which include high inflation, high commodity prices, Russia-Ukraine war, expected high interest rates, and expected recession in U.S. economy. High inflation. This is causing concerns that the U.S. economy may be overheating and that interest rates will need to be raised in order to cool it down. This could lead to a slowdown or even a recession. High commodity prices. This is adding to inflationary pressures and is also leading to higher costs for businesses. So inflation might come down to 1%, but let's say utility companies put up their prices 5% or food is up 2%. The cost of actually living and doing business are going to be higher, while incomes remain relatively static. Russia-Ukraine war. This is creating geopolitical tensions, making investors nervous and leading them to sell stocks. The Russia-Ukraine war is fueling the current crash in the US. The main drivers of the crash are fears of a global economic slowdown and concerns about corporate profits. Expected high interest rates. If interest rates are raised as expected, it will make borrowing more expensive and could lead to a slowdown in economic activity. If you're carrying a lot of debt, rising interest rates will make it more expensive to service that debt. This can impact both businesses and consumers. For businesses, it becomes more expensive to borrow for expansion like building new stores, hiring new staff, etc. For consumers, it becomes more expensive to borrow for big-ticket items like cars and houses. This can lead to a slowdown in economic growth as people spend less money. Expected recession in U.S. economy. There are growing concerns that the U.S. economy may be heading for a recession, which is making investors hesitant to buy stocks. While the U.S. economy is not currently in a recession, there are several indicators that suggest it may be heading for one. These include the yield curve inverting, long-term interest rates falling below short-term interest rates, an increase in initial jobless claims, a decline in consumer confidence, a slowdown in manufacturing activity. If these trends continue, a recession is likely in the near future.
If you like the video, press the like button and don't forget to subscribe to our channel for getting latest updates from the world of financial markets.